Good day, everyone. My name is Wasku Smart FX. Welcome to our channel, our YouTube channel. Or in case you see the video on TikTok or on Facebook, welcome to our channel. So, in today's video, we'll be talking about the market structures. Out of the three layers of top-down analysis, market structure is one of the layers. So which means that there's no how you will be so good in top-down analysis without a full understanding of market structure. And market structure as a topic is a wide topic that has a lot of components, that has a lot of subtopic under it. This is how it goes. Top-down analysis, out of the layers of top-down analysis, we have market structure. Okay, let me tell you the three layers of top-down analysis. Number one is market structure. Number two is order flow, and number three is candle science, or something I can call an entry confirmation. Because there is no what's the essence of top-down analysis without you entering the trade, or without you looking for a confirmation to enter into the trade. So those are the three layers of top-down analysis. So looking at market structure, there are also components that comes together that brings the topic of top-down analysis. Something I can call a short time high, short time low, intermediate time high, intermediate time low. All these market range. All these are what comes together to bring market structure. But in a layman forms, one thing we all know, as every trader that starts learning the market from the beginning, we all must know about trend. Yeah, you have the bullish, the bearish, and the consolidating one, right? That one is the layman's method. And the way you can identify the trend in the market, it can only be known by market structure. Then, when we all begins the trading, when we all begins learning, there's a way you can just look at the market and be like, okay, this one is bullish, right? Exactly. So, but now you have to be intentional and do it in a mechanical way, because you have to learn how to know this is bullish and this is bearish and this is consolidating. So, but today I will not really be going much into the market structure because it will be a wide topic. So I'll be teaching it a little by a little, then like little. So today we are looking at something I call the intermediate time high, intermediate time low as an entry pattern. That is the topic. Intermediate time high, intermediate time low as an entry pattern. Because I know you have to do top down analysis all through down, but yeah, I just want to teach you how you can know when it comes to intermediate time and intermediate time low, they call them the outsiders of the market. And when we are talking about the outsiders, we are talking about the market structures or the structures that are outside, which means that they are the one that create a price range. Okay, let's look at this market here, JP card. Let me look at 4 hours chart. Okay, if you look at this high to this low, on this high we have an intermediate time high, on this low we have an intermediate time low. They are the outsiders, like they are the ones that we have the internals. So all these intermediate time high, intermediate time low, they are the externals. So what you want to do is that ability to be able to cash both intermediate time high, intermediate time lows, so that we can be able to trade the external to the internal, or the external to the external. People says the right way to trade is trading the internal to the external. But here we are only want to trade external to externals, or external to internal, because when you trade an externals, when you enter a trade with an external movement, it means that you will have more confidence in that trade, because the stop loss is at the intermediate time low. So it is very difficult for market to come to intermediate time low to break it, except if you get the market structure wrong. That is the only moment. Okay, let's look at this JP card. I want to tell you how you can trade external to internal using intermediate time high on the intermediate time low. And I know if you are watching my video for some times, we are following up. I've said this several times, talking about that market only do two things. Is that market is seeking liquidity or is offering a fair value. So whenever market is no longer offering a fair value, the market is seeking liquidity. I want you to have this on the back of your mind, like just have this in your mind, place. That's automatically just look at the market in that way, and some light will be shining at you. Okay, before I continue, let me just try to draw out things we are looking out for in this. Yeah. Okay, this is what we are looking out for. This is what we call an intermediate time low. Let me start from low first. We have a short time low or a swing low. The market retraces, the market comes back again. The moment, okay, market creates a new low and breaks. The moment market breaks this high, then it gives a confirmation that this low is validated. Then we have a swing low, a intermediate time low, and a swing low. So which means that all these are market structures. I know I will still talk about the short time high, short time low, how to identify the market range. That one is in other topic entirely, because I told you that market structure has more component that comes together. So but ability to be able to identify today is just about intermediate time high, intermediate time low. So whenever this market break this structure, this high, and create a fair value gap, what it means is that this is now an intermediate time low. It is now called an external. It must be secured for market to get to where market want to get to. Is either market is seeking liquidity or offering a fair value. This low must be secured till market get to where it's going to. That's why I said the external is so secure to trade, because you just put your stop loss there and you are not expecting market to come back there. If market come back there, it means that market is no longer doing that. Market is doing another thing entirely, and it can be seen on daily charts. Can be seen on daily chart what market is doing too. So that's that. So opposite of it is the intermediate time high. So having one, then two, then so this intermediate time high having the reversing, and so it can be called a reversing pattern. So let's look at the charts. So on this particular, let me go to daily chart to show you what I saw first. So I saw market took out this liquidity here. Market took out the liquidity below here. So going down to 4 hours. So I was looking at the market structure. Okay, here the main market took out the liquidity. We have a low. This here trade back into this whole range. You know, we have this low to this high. The market breaks it, break this low. Then this here is what we call the fair value area. So from this low to this high, market breaks it, then come back to it. Then we have a continuation that market want to continue to sell, right? So that's not the catch. Then the moment market goes up, comes back again, then goes up. It was able to take out this high, then reverse back, then goes up. So the moment market breaks this high, it gives us a confirmation that this low is an intermediate time low. So which means that market should not come back to this low if market want to buy. Then you have a a fair value gap here, and don't forget this low here is a daily liquidity tap. So it means what it means is that market took out a liquidity, the market creates an intermediate time low on 4 hour chart, which means that market is no longer coming back to that low, and market seek a liquidity. Then don't forget I told you that this pattern is called a reversing pattern. So whenever you see an intermediate time low or intermediate time high, what it means is that market want to reverse potentially, or that's just it. Market can do anything. Don't get me wrong. Don't say anytime you see intermediate time low, intermediate time high, that's all. Market can do any other thing. Market can took you out at any time, but this is what market is doing. So having this, then you can put your take up your entry here. Then you take profit is either to this, because we have here also, we have this low here can serve as, this one can serve as a proportion block here. That low can serve as a proportion block. So let's look at the this thing. I took the trade actually, so let me show you mine. So I just want to show you how the trade goes, and like things that comes together for the trade. It's not really like I'm just trying to talk about it. Okay, this is the trade there. You can see JP card when I gave them the trade, and I think let me show you the take profit here. When it was going, Okay, when let us see. I'm sorry. Okay, okay, this is it. When market hit the take profit, you can see where my take profit, my stop loss is. My stop loss is at the short time low. We are still going to talk about short time low in the next video, but today is just about intermediate time low. If I want to be secure, if I know I'm really looking at the risk reward ratio. I want to have a good risk reward ratio. That's why I put it at short time low. But my mind told me that, or what I know was like market should not come back to this low. And if I put it here and I have to put it at the intermediate time high. This is an intermediate time high, so that is why they are called the externals. They are outsiders of the market. No, a lot of things happen. This from this low to this high is an internals. They are the insider of the market, but these here are the outsiders. That is why they are called the trading range. So you have to first understand your trading range, and you have to make sure that you train your eyes to understand both the external and the internals of the market. So let's look at gold too, because it happens on gold, but I was able to give them this the entry because yes, because guess what? Because it has a lot of stop loss. So imagine having a stop loss of 150 pips. Because gold recently has been high based on price. So and I can't just give them this. So you can see what happens then. You can see this gold here 1 hour chart. You can see this low trade back to a fair value gap here. Market break these structures. Market break the structures, then come back again. You can see market come back again, but was able to take this high. Market trade into the range. There's a fair value gap here. Market trade back, then it was unable to take this low. The market breaks this high. The moment market break this high, what does it tells you? It tells all this pattern that we have that I draw for you the other time. So this is old strategy, this is old patterns, and the fair value gap for buy continuation. If I were to put my take profit, my entry, see where my stop loss will be, and see where I'll put my take profit. So you can see the pips for the stop loss, that is 260 plus. So that's the reason why I did not give the trade out, because the stop loss is so much, and though the trading or the strategy used is high profitable, but the stop loss is so much. So I was looking for how to reduce the stop loss, and that's why I miss out on the trade. Sometimes when you want to refine your entry patterns, you can miss out on the trade. If I were to give them like this, the stop loss is so much, so that's just why. So don't forget to like, share, and subscribe. And if you want to join my Telegram channel, link in the description. Thank you so much. See you in the next video. Don't miss out. We'll be talking about the short time high, short time lows, and also talking about the price range so deeply and perfectly. Thank you so much. I love you all. Thank you.